Hello, everyone. Today, in our course, Development of Digital Currencies, we will cover Section 5.1, Major Risks of Digital Currencies. While digital currencies enhance payment efficiency and reduce transaction costs, they also expose a complex and diverse risk system. In this section, we will systematically analyze the risks faced by digital currencies and reveal how they impact the traditional governance framework in finance. This section focuses on the core risks of digital currencies from 4 dimensions: technical security, financial stability, legal compliance, and social ethic. After this lesson, you will be able to 1. Identify single point of failure and quantum computing threats within the technical architecture of digital currency. 2. Analyze weakening mechanism of CBDC to the intermediary functions of commercial banks and the transmission paths of systemic risk. 3. Evaluate, in cross-border digital currencies scenarios, the jurisdictional conflicts and regulatory arbitrage. 4. Propose principles for designing governance frameworks that balance between financial innovation and risk prevention and control. First, let's look at technical security risks. The technical architecture of digital currencies is advanced, yet it also has many vulnerabilities. 1. System resilience. In terms of system resilience, distributed architecture is not impregnable. For one thing, the failure of a single node could trigger a chain reaction, causing regional payment disruptions. For another, public blockchains like Bitcoin face a fundamental threat of 51% computing power attacks, which means if a mining pool association monopolizes the majority of the computing power, it gains the ability to alter transaction records and carry out double spending attacks. 2. Cryptographic cracking. Cryptographically, existing encryption systems face dual challenges, both internal and external. Externally, the rise of quantum computing poses a disruptive threat. Its Shor algorithm is able to break ECDSA elliptic curve encryption theoretically, threatening the key systems of existing digital currencies. Internally, applications in certain scenarios also harbor hidden risks. For example, double offline payments in offline environments might be susceptible to relay attacks or chip cloning, requiring reliance on hardware security modules, HSM, for end-to-end encryption. 3. Privacy protection. Privacy protection presents a dilemma paradox. Privacy coins with strong anonymity, like Monero, face global regulatory crackdowns due to their abuse on the dark web. Conversely, the full traceability of account-based CBDC, while beneficial for regulation, sparks strong public controversy over privacy infringement due to excessive transparency. Zero-knowledge proof technology is needed to achieve controlled anonymity. Next, let's explore financial stability risks. The widespread adoption of digital currencies could reshape the traditional monetary system, leaving profound implications. Main financial stability risks include 1. Bank disintermediation effect. Deposit migration pressure. If the public converts large amounts of commercial bank deposits into CBDC, it could reduce credit extension capacity of banks. According to Bank for International Settlements (BIS) models, a CBDC penetration rate of 30% could narrow bank interest margins by 45 basis points. Liquidity crisis transmission. In extreme scenarios, A rapid run on CBDC could trigger liquidity shortages in the banking system. Therefore, mitigation tools like tiered interest rates or holding limits need to be designed. 2. Obstruction of monetary transmission. 1. Ineffective interest rate corridor. CBDC, as a risk-free asset, might replace national bonds as the new anchor for market interest rates, weakening the effective operations of central bank in open market. Hindrance to implementing negative interest rate policy. The zero lower bound on nominal interest rates for digital currencies might force central banks to adopt technical deduction mechanisms, as seen in the Swedish e-krona design. 3. Impact on cross-border capital flows. Accelerated currency substitution, CBDC, from power countries like a digital dollar could erode the local currency status of emerging economies, triggering capital flight to regulated arbitrage corridors. Offshore digital currency trading platforms circumvent foreign exchange controls. In 2024, the International Monetary Fund, IMF, called for establishing a global CBDC information sharing mechanism. Now, let's examine legal compliance risks. The cross-border and decentralized nature of digital currencies poses severe challenges to traditional legal frameworks. Main legal compliance risks include 1. Sovereign legal conflicts. 1. Jurisdictional gaps. Disputes over cross-border Bitcoin payments involve conflicts over the applicability of laws. The Mt. Gox exchange bankruptcy, a classic case, took 8 years, and its cross-border creditor claims remain unsettled. 2. Determination of digital currencies' property rights. Article 127 of China's Civil Code includes online virtual property within its protective scope, but specific determinations of rights and liabilities lack judicial interpretation. 2. Anti-money laundering challenges. Mixer technology, evading tracking. Tools like Tornado Cash can anonymize Ethereum transactions. In 2022, the U.S. Department of the Treasury sanctioned related protocol addresses. 2. Regulatory vacuum for DeFi protocols. Decentralized finance platforms that did not implement KYC verification saw global money laundering reach $7.8 billion in 2023, marking a 180% year-on-year increase. 3. Dilemma of legal validity in smart contract. 1. Code vulnerabilities causing systemic default. The DAO incident, due to a contract recursive call vulnerability, led to $60 million assets being hijacked, ultimately resolved through an Ethereum hard fork. Difficulty in recognizing contingent liabilities. The automatic execution of on-chain contracts might create unforeseen legal obligations. Current contract law struggles to cover conditional trigger payment clauses. Finally, let's come to social ethical risks. The proliferation of digital currencies could exacerbate social inequality and raise new governance challenges. Main social ethical risks include 1. Worsening digital divide. 1. Equal technology access. Elderly and low-income groups, due to lack of smart devices, might be excluded from the digital currency system, worsening financial exclusion. 2. Knowledge barriers. Technical thresholds like private key management and wallet backup lead to user asset loss. In 2024, approximately 2.7 million Bitcoins worldwide were permanently locked due to key loss. 2. Platform monopoly and data hegemony. 1. Struggle for control of payment gateways. Large tech companies might collect user spending data through wallet apps, creating digital identity monopolies. 2. Pressure on data governance of central bank. If abused, CBDC transaction data could evolve into a social credit monitoring tool. Independent data governance committees need to be established. 3. Public trust crisis. 1. Concerns over technical black box. Ordinary users find it hard to understand underlying logic, like consensus mechanisms, reducing trust in the system. Amplification effect of crisis events. The collapse of the algorithmic stablecoin Terra USD triggered panic runs by retail investors, wiping out $40 billion in market value within 3 days. Class. Today, we systematically studied the 4 core risks of digital currencies: technical security, financial stability, legal compliance, and social ethical risks. Through analyzing these risks, we see that digital currency risk governance is essentially a dynamic balancing process between financial innovation and system stability. A 3-dimensional prevention and control system between technology institution, international cooperation needs to be built. Only by proactively identifying risk evolution paths can we safeguard the bottom line of systemic security in the digital financial revolution. Finally, please complete the following exercises. That's the end of today's lesson. See you next time.